That's the word I'm looking for. There's still just a few people coming through here, so I'm just gonna hold off for another kind of 30 seconds before we get started. Thank you very much for joining us. Okay, that's enough time for people to jump on now. Let's get started. We're going to talk today about a number of different things on China, so I'm going to rattle through it. But as I said before, please do ask questions as we're going along. I'll probably take those at the end, but please do ask questions, and if there's anything that needs picking up as we're going along, then I'll take those as they come. We're going to talk about the unavoidable, the trade deal, trade truce, trade mini deal, trade progress, or whatever you want to call it, and give you our kind of latest on that because it is so kind of fundamental. And we're going to look at the credibility of China's threats in the context of its economic cycle. And then we're going to take a big step back and look at more structural issues, whether China is coming to a multi-decade turning point, particularly as pertains to the renminbi and the potential for a downshift in the renminbi in RER terms. That this could be happening over the next kind of 1 to 2 years. And as a part of that, I want to tackle the monetary policy targeting system that has arisen over the course of this year, and I think is a very underappreciated story as to what this actually means for China in the next kind of 2 or 3 years, that they might actually potentially unwittingly be running the economy too tight. So we'll go into that as well. To give you the quick takeaways, mini deal or whatever we want to call it, but this partial trade deal, I think that probably will happen. We probably won't see a rise in December tariffs. That will be avoided. These are all with large degree of uncertainty, of course, because we are mind reading here. I think a comprehensive deal is now looking much less likely. I think in turning to growth, we're looking at a U-shaped recovery. It'll be a disappointing recovery. And as I said about the structural side of things, we're probably looking at a turning point, especially with regards to the renminbi and the RER valuation of that in real effective terms within the next couple of years or so. So the trade side of things, taking both perspectives, the Trump perspective and the Xi perspective, and looking at the incentives that we have there, it's becoming clear from the US side of things that the tariffs really are causing a major slowdown, or will be causing a major slowdown in the economy. You can refer to Ian's work to see the impact that this is already having on inflation, on the goods where there have been consumer tariffs implemented already. And there's an election coming up, and it's not a great look to be slowing the economy and stoking inflation right before an election. So that's a quite simple calculus, actually, that the closer we get to that election, the more likely it is that Mr. Trump will try to go for a deal, but also that we think that they've reached the kind of the peak of what they're really willing to sustain in terms of tariffs. Now, it's a hugely volatile situation, so I'm willing to eat my words with the next tweet, but that seems to be the bigger picture side of things, that they seem to have reached. They seem to be lacking stomach for higher tariffs, and ironically, the geopolitical side of things recently, the bill on Hong Kong and the measures that were implemented on Xinjiang, these really signal to me, ironically, that Mr. Trump has reached as far as he can in terms of tariffs, and is now trying to look for a new front on which to quarrel with China. That, whether he knows it or not, makes a comprehensive deal much, much less likely, and I'll quickly say where that is. But in the short term, it seems to me to make a mini deal more likely, at least in the context of how the Chinese side is responding to that at this stage. At this stage, again, I think because there's still quite a wide degree of vagary, and there's not a great deal of detail on these the components of the mini deal. That, again, ironically to me, indicates that we still have the potential to avoid these December tariffs and get a mini deal over the line. Thinking about this strategically from both sides, but particularly from the Chinese side, if they are now unwilling to do a deal with Mr. Trump and to give any leeway on the bigger issues such as government subsidies and industrial policy, which are the Made in China 2025, they need to leave some low-hanging fruit. So they've managed to avoid the October tariff hikes, but that they still need to avoid the December tariff hikes. So for them to sign away all the low-hanging fruit in the lead up to the October tariff hikes would have been a strategic mishap, a miscalculation. I think instead what they've done is to say, well, yes, Mr. Trump, it looks like there's something we can do here with a partial deal, but then there was a lot of there was a severe difference in the way that was reported in the Chinese press from the US media. And therefore, they've left themselves that bit of leeway to be able to nail down a deal in coming weeks, and hopefully to pin the avoidance of the December tariffs into that. I can't help but reiterate again that this is a very uncertain situation. From the Chinese side, the reason why I think a comprehensive deal is now pretty much off the table, there's a couple of reasons for that. Firstly, that geopolitical twist is a difficult one for them to overcome. The way in which, or one of the ways in which the Chinese authorities are trying to prevent the troubles in Hong Kong from spilling over into the mainland is to stoke this notion of there being outside interference within Hong Kong, particularly with reference to so-called black hands, which is an idea of US agents paying off protesters to go out there and protest. As ridiculous as that may sound, this is the way that they're trying to prevent this from, or one of the ways they're trying to prevent this from spilling over to the mainland. So for Mr. Trump to then turn around and say, hey, look, they're waving US flags and singing the national anthem, they think I'm great, they want to make China great again, that is no more than a kind of a red flag to a bull from Xi Jinping's perspective. And for him to be seen to be getting into bed with Mr. Trump in any way more than a kind of a comprehensive, a mini deal, or kind of progress, as they labeled it in the Chinese press, that would be very politically difficult. And then there's just the simple calculus of why would you want to hand Mr. Trump a win right before the elections, when you can hold off and potentially get a better deal with another administration within a few months. I'm thinking from the perspective of next year. So that comprehensive deal now looks much less likely. A mini deal, I think, probably is still in the offing, but the Chinese side is downplaying that, and I think there's a kind of an obvious reason for that with the lack of trust. Now, why would the Chinese even go for a mini deal, given that there's been this increase in hostility on the geopolitical side of things? Well, that's because the economy is very weak, more than 18 months into the easing cycle. So at this point, we'll go into the charts, and we see here in our forecasts that there looks like there's just this kind of long period where growth is not really doing anything, and then you get this bit of an uptick here. But I would probably be projecting this down quite rapidly after that, and I'll explain why. This little uptick that we have just here, that's all based on the assumption that some of the monetary easing that has happened so far will actually feed through. At this stage, there's not a great deal of evidence that that is the case, but that's the forecast still at this stage. Q3 we're expecting out tomorrow. In reality, that probably was really quite dire. So these in the black bars are our own calculations of Chinese GDP, starting from the nominal GDP, using the price data and compiling a deflator. And that's what you get here. It's much more volatile than what you see in the official numbers. If you look back to this chart, there's actually a cycle in the black line, which is our estimates versus not so much movement in the blue line. So Q3 looks pretty dire based on the activity data. A sharp slowdown in industrial production growth quarter on quarter. Similarly, in retail sales volumes, there was a very sharp slowdown there as well. And then just based on the previous monetary tightening that has gone on, I don't think that's fully fed through yet to tighten or to slow down the real economy. So I think we'll see a bit more of that in Q3. In addition to which, we've got a bit of a tariff, quite a serious tariff drag there as well. So Q3 is not looking great. We'll have those data out tomorrow. I will do a wrap on that, but we are on a holiday, so it will be covered in the wrap. The way in which we forecast, or one of the ways in which we forecast nominal GDP growth, is to look to M1 growth and to put household demand deposits into that, because in the official data they don't actually include household demand deposits. In fact, household demand deposits actually has the best fit if you just use household demand deposits over the past few years or so, but I've put in the corporate deposits, which are in the official numbers as well. Just because I think we need to be looking at not just the household sector or just the corporate sector, but looking at that wider gauge. Now, what's worrying is that there's not much of a pickup here. There is a bit of a pickup. And then this is, as I said, this is still kind of forecast based on the previous monetary loosening actually feeding through. But as I'll get to as we go through the presentation, that pace of loosening has not been maintained. So it's hard to see that quarterly increase in M1, even at these very low levels, it's hard to see that that's sustainable. But there is some good news, which I don't want to make you all feel too dismal. It does seem as though there might be some indication that there's a bottoming out in real imports. Unfortunately, we don't have enough data yet to really confirm whether that's the case. They could still be on this downtrend here. And there's been so much noise with the tariffs that it's quite hard to piece that apart. On the export side, it looks like we're still continuing with this sideways trend here. The reason why I can't quite yet get comfortable with the idea of a rebound in real imports is in the following slide. But before I just go on to that, I just want to make one more point here, is that the markets and commentators really tend to be very focused on those year-over-year numbers. What we're doing here is to get down to the volumes side of things and to look at the levels and to look at the 3-month changes, so that we're really getting more of an up-to-date impression there. So I was more optimistic than those dismal year-over-year numbers that we got out a few days ago, but not entirely convinced that there's going to be any kind of a strong rebound yet in either imports or exports, because the leading indicators are still pretty dire. So this is the PMI export sub-index, and that's pretty unpleasant. I'll get to the Tyson version, but for the moment, the official version is looking still pretty unpleasant. It does sometimes underpredict, as you can see in this period here, but this is quite a long, sustained period where we've just been down in what's known as the doldrums. Similarly, we've got quite the same story on the import side. And I wasn't going to put M1 in every chart, but if you look at M1 in dollar terms, that's still pointing to a quite deep contraction in imports year over year. Some more good news, though. There does seem to be some kind of a recovery in the private sector going on. And we can see that in a few different data sets, which gives us a little bit of confidence that it is actually picking up something. It's not just noise. So private profits, as you can see in the black line here, look like they're on this little bit of an uptrend. These data are not the most reliable because unfortunately there is a threshold and firms come in and out of the samples, so we have these sampling issues, but that looks like a sustained uptrend to me. And it coincides with this uptrend in the Caixin manufacturing PMI, which tends to be more reflective of the smaller firms. So yeah, there's a lot of volatility around there. This is probably going to come back down again in the print next week. But it does look like there's an uptrend there that's not being picked up by the official numbers. And similarly, there's not any kind of a uptrend in the state-owned sector for profits. Again, the reason why I can't get quite comfortable yet with the idea of this Caixin PMI continuing on up is because monetary conditions are still just too tight. They're kind of bottoming out there, but that uptrend there is very weak still, and it doesn't look like it's that sustainable over more than just the next kind of few months or so. And the reason for that concern as to the lack of the sustainability of the uptrend in M1 is, as I alluded to before, because the authorities haven't kept up the pace of monetary loosening. So here we have the change in 3-year sovereign yields and the M1 plus household demand deposits growth. So this is the year-over-year change. We've got a bit of a pickup in this M1 uptrend here. That to be honest, I've had that in there for quite a while and it hasn't really come through. I'm still holding out for it because there was this kind of increase in or this faster pace of monetary loosening back a few months back. This leads by 9 months, so that should be feeding through. But it hasn't really come through in any way yet. And then we can't really see much of a pickup after that because this is all leveling off here. And I'm even penciling in with this forecast a reduction, a 10 basis point reduction in the interest rate corridor, which we think is coming before the end of the year, potentially next month when there's a lot of medium-term lending facility loans due to mature. That might present the PBOC with an opportunity to cut rates. So it's hard for me to see this picking up much more strongly. You do get instances where there is quite a long lag and then you get a massive pickup. This era here was actually a little bit overstated by some kind of changes in categories that were going on. But it could be the case that we're just having a longer period between, or there's a longer lag this time around. And it would also help if there was a trade truce, because at the moment, the authorities are relying on the private sector to get out there and do the borrowing. And they're not really too enamored with the idea, given that PPI is in deflation and that there's a trade war going on. There's a very high degree of uncertainty. That uncertainty really is probably not going to go away, although we might get a boost from the avoidance of tariffs. Now, we're going to switch gears here a little bit and look at the longer term story. And this chart, to me, is one of the most worrying charts for that 2 to 3 year outlook. And it speaks to this new monetary policy target that they have of trying to keep M2 growth level with approximately nominal GDP growth. Now, that's quite a laudable aim, but the problem is that's more of a result than something that they would do as a policy to change something else. So to give you a bit more of an idea of what I mean by that, the authorities are trying to broaden out the financial sector so that the allocation of credit is improved, and they're not so reliant just on the banking sector. But that's a very long, multi-year endeavor. So if I take a comparison between the likes of China, say, and the likes of the US, velocity, or let's keep it to M2 versus nominal GDP growth. M2 growth is faster than nominal GDP growth, but not to the same extent as it is in China. This is quite a large gap that we have here historically. And the reason for that is because the US financial sector is much more diverse than the Chinese financial sector, which is very much focused around banking. So if the authorities simply go for this measure of forcing M2 growth to equal nominal GDP growth, then actually what they're doing is depriving the economy and the financial system and the real economy of the lubricant that it needs to be able to function. Historically, this blue line, M2 growth, has outpaced nominal GDP growth by several percentage points, and it also tends to lead by 2 to 3 years. So if we're now saying what we really need for this black line to pick up, nominal GDP growth to pick up, is for M2 growth to be already well above nominal GDP growth. Instead, it's level pegging, which tells me that in a couple of years, nominal GDP growth is going to be kind of down here somewhere. And if that's where nominal GDP growth is, then real GDP growth will be 2 or even 3 percentage points below that, depending on what commodities are doing, probably about 2 to 3 percentage points below that. So that the authorities, to be fair, are very much preparing markets for the idea that we won't be seeing 6% growth. I think they'll continue to publish 6% full year growth in the next year and potentially the year after that, because that's what their medium-term targets of raising people out of poverty imply. We'll probably see some quarters of sub 6% growth. Q4 might be one of them. But it seems like in reality, what's going to happen is that nominal GDP growth is going to be trending down as a result of them having kept monetary policy too tight, and that downtrend will be more severe than they're expecting. So essentially, keeping M2 growth at the same level as nominal GDP growth is a recipe for nominal GDP growth to continually spiral down until they abandon that policy. Bringing things back to the here and now, the other way in which the authorities are keeping the economy and the financial sector very tight is by refusing to loosen the reins in any way on the shadow banking side of things. These main shadow banking instruments have been in contraction now for a very long time. At some stage, you would assume that just by pure base effects that they will start to expand again. But they've been very, very tight in terms of keeping that. Keeping the financial sector, the shadow financial sector and shadow financial activities under wraps. One piece of good news again is that this drag from the ability of non-financial corporations to derive money from the so-called interbank market, that drag looks like it's diminishing now. And that's been a massive contractionary force here for non-financial corporations. So just a couple of details on how this works. In 26 or until kind of 2016, the non-financial corporations were using their financial arms to go into the so-called interbank market and pull out funds at lower interest rates than were available elsewhere. The authorities clamped down on that extremely hard, and that's been a major part of the slowdown in or the tightening of monetary conditions, I should say. It looks like that drag is easing, but we're obviously nowhere near back to where we were in this kind of pre-16 period. And turning back to the conventional side of things, there's just no evidence yet that there's been any kind of bottoming out of or recovery in conventional credit growth. Again, with the money and credit data, I think the market focuses on the wrong thing. There's always this focus on new loans and the monthly flow, and also the total social financing, which is just a very, very muddy indicator, including a whole bunch of different things and double counting. If you just look simply at the growth of loans to households in the blue line, growth of loans to non-financial corporations in the black line, there hasn't been any kind of an improvement there. We're still kind of on this downtrend. And it's very hard for me to see how China turns around without this improvement in credit. Now, you might have noticed that there was the beginnings of an improvement in M1 growth, and that, putting that together with these credit data, tells me that the authorities have been getting liquidity out there through another means, which I'll get onto later. But before we get to that, what are the authorities going to do about the private sector side of things and trying to improve, or trying to get the economy out of this trough? Well, as I said, I think they'll probably do a 10 basis point reduction in the interest rate corridor. I'm going to try very, very hard not to go off on a massive tangent here, because I've been doing quite a lot of work on what this line here actually means. If anyone's interested in that, there's a big opposite. There's an opposite definition of what reverse repo means in China. So there's a bit of a weird thing going on there, but I'm gonna restrain myself from going down that tangent at this particular moment in time. 10 basis point cut coming through there, it probably won't be enough, because they're wedded to this idea of the M2 growth equaling nominal GDP growth. So it seems like they think they're probably doing enough to stimulate the economy at this stage. On the moving from the private sector to the local government side of things, that's where I think we probably, or the reason why we have seen a beginnings of an uptick in M1 growth and a slight loosening of monetary conditions. So this issuance of local government debt helps the economy in two ways: directly by helping to boost infrastructure investment, and then also by helping to loosen monetary conditions, because the authorities at the end of last year made it easier for banks to buy the bonds which they're underwriting. That means when the PBOC is lending to the commercial banks, and the commercial banks are buying the bonds from the local governments, then that money gets out into the real economy and becomes part of broad money, or M1 growth in this case. And this issuance here is significant in the context of the monthly increase in M1. So the problem on the real economy side is that infrastructure investment has not by any stretch of the imagination been enough or been stable enough to ensure that the whole economy is recovering. So fixed asset investment growth in the last data was slowed, despite the fact that we saw an uptick in infrastructure investment growth. So the drag from manufacturing was enough to outweigh that. And that's really the problem that they're facing. So despite those that uptrend in profits growth that we saw in the private sector, if that's real, it's not feeding through to the to capex. So what else can the government do? Can they rely on the fiscal side of things to boost the economy? Well, they've kind of already done that, and there's not that much more space to really to loosen on this side of things. When the authorities back in March made this little tick down in the government deficit as a percentage of GDP, so this is the target. That was, in my mind, pretty ridiculous given the tax cuts and the slowing of the economy, and something much more like this downtrend seemed pretty obvious. In fact, from the rhetoric at the time, it was pretty obvious to the authorities as well that they weren't going to be able to reduce the deficit by, or they weren't going to be only expanding the deficit by 2 percentage points. The problem that they're having is that they've cut taxes. The economy is slowing. So far, they haven't gone to this kind of knee-jerk reaction of boosting expenditure to the same extent as they have in previous cycles. In fact, they've hardly boosted it at all. And local governments in particular are in this pretty nasty situation where they're being told to cut taxes. The most recent state council meeting, as in yesterday, they're promising to cut taxes even more and to force through the implementation of those tax cuts, which local governments are kind of really actually pushing back against. At the same, and the only way that they can protect their deficit and meet their quotas for the debt side of things is to cut back on the expenditure side, which, when the economy is slowing in the way that it is pretty pro-cyclical. Sorry. So the reason why we're seeing this fiscal kind of hawkishness in the context of the slow economy as we've seen is because, partly, I think, because the authorities maybe have cottoned on to the fact that they don't have the external surplus that they used to have. This is the current account surplus as a percentage of GDP in the black line. And you can see that it's been whittled away to very little, and that they actually astoundingly ran a deficit early last year. And for a so-called an excess savings country, which China undoubtedly still is, that is quite a remarkable thing. So that expansion of the deficit was financed in large part by foreigners, that they've really kind of turned the tables of how they normally interact with the rest of the world and briefly entered that twin deficits camp. Now, the renminbi has depreciated since then, and that partly has helped to rebuild the surplus, but mainly the thing that's helped to rebuild the surplus has just been that the domestic economy has continued to slow, so imports have done worse than exports. So I think I'm probably not going to go much into the detail of the breakdowns here, just because I'm aware that the time is moving on. I want to allow some time for questions as well, but we'll come back to me on the breakdowns there if that's of interest. Now, on the structural side of things, I want to come back to that chart that we looked at, that I called the most worrying chart in China for the next 2 to 3 years. And reassess why that's a worrying chart using Japan as a precedent. So in China, what they're aiming to do is to improve the allocation of the efficiency of the allocation of credit, and improve the way in which the economy uses credit, so they get more GDP out of each unit of credit. That seems like a very unlikely thing to happen unless they're allowing large-scale defaults, so that capital can be freed up to flow to the more productive parts of society, parts of the economy. And this, I'm relying here a lot on the kind of bigger picture stuff that we've done before with regards to the 4 different paths that China has for the future, as we see it: the Japanization of growth, the Korean tangent for growth, the successful transition to private consumption-led demand, or the Armageddon debt blow-up. I'm not going to go into those in any detail this time around, because we have covered that a lot before. There's a special report and a video that we can send to people if that's of interest, to get that bigger picture story. But the Japan story is our base case for how China unfolds over the next kind of 10 or even 20 years. So looking at Japan as a precedent, and trying to work out what this idea of M2 growth equals nominal GDP growth really means in that context is I think a useful exercise. And we can see in Japan that M2 growth does outpace nominal GDP growth by quite a substantial lick. That's more than 2 percentage points on average over that period. So what's going on here, and why, and what are the asset allocation implications? Well, as we all know, there has been this huge migration of debt from the private sector to the state-owned sector, to the government sector. And that seems to entail money being created as a lack of demand, as a result of a lack of demand in the economy. So the government is running the deficits and the private sector is running the surpluses in order to achieve this deleveraging of the balance sheet. And the result of that seems to be that there's just more money than the economy really is demanding, because that money is being created as a result of the government running a deficit and borrowing that from the banking system. So the banking system has been buying up those bonds until the Bank of Japan took over, and essentially they're monetizing the deficit in that sense. So the money is created as a result of a deficiency of demand in the private sector, and that means that there's just too much yen compared with what's purchasable in yen. And the result of that seems to be that there's this continual effort to gain returns abroad, and the continual capital outflow. So you get this very long-term depreciation of the yen in real effective terms. Now let's bring China back into this story and try to work out where China is with respect to that deleveraging process in the private sector. So China does reasonably well early on. So I've started this chart for China in 2007, and I've started it for Japan in 1981, and this is BIS data. Just for comparability, it's not our estimates of debt to GDP. And China does reasonably well initially, but then you get this big upstretch here where they probably accumulated a lot of bad debts, and you get this big uptick here where they probably accumulated a lot of bad debts. And then we see a leveling off. Now, whether that leveling off continues in the way that it did in Japan for another couple of years, and then you get the massive turning point, or whether that just goes, they begin that deleveraging process in earnest now, as the authorities seem to want to do, with keeping monetary conditions as tight as they are. That's quite a big call, but it seems to be the case that in the next couple of years or so, we are going to see the renminbi moving from this sharp uptrend in real effective terms, that's relative unit labor costs, to a multi-year, multi-decade decline in the real effective exchange rate. So I'll leave it there. Any questions are very much welcome, either just now or by email or Bloomberg or through the usual channels. As I said earlier, the questions are anonymous, so don't feel that we're putting you on the spot here. But if there are no questions, then I will finish up here and thank you all very much for listening in. Fire any questions at me by email, and as I said, thank you for listening in.